Hello everyone and welcome to Tax 1. My name is Tim Samanda and I'll be going through uh, the various concepts and principles relating to individual taxation in this course with you. I'll be facilitating your learning experience for each week, and a couple of things I want to mention before we get started. First of all, this is a fundamentals tax course, and so we'll be going through the very basics of individual taxation. And we may occasionally touch upon business taxation concepts as they relate to our discussions within the chapters, but the primary focus in this course will be on individual taxation. We will not be preparing tax forms per se. We will be preparing portions of tax forms. We will be, within the chapters, reviewing tax forms, but we really want to learn and focus on what is behind the completion of these tax forms, how to understand these rules, principles, administrative procedures, and so forth, so that we have a good understanding of the tax code, and so then we can use that in the event we prepare taxes later, and it'll make preparing taxes much more straightforward. So to the extent that it aids our learning experience, we will be preparing portions, as I said, of tax returns, and we'll be reviewing tax returns, but only to fortify our discussions of the principles that are behind them. All right, so also, whether in this video or the next, I'll be discussing and going through some templates I've set up to assist you in understanding some of the problems that you'll be given every week. And then also, these templates can be used to check your work after you've submitted your assignments to Connect. And I'll go through that and show you how the templates work and how they may be used to assist you later on. Right now, let's get started then in very basic concepts of Chapter 1. So the tax code really levies taxes against individuals based on a variety of structures. One is progressive, the other is proportional and regressive. So what is progressive? Progressive generally is the federal tax scheme that we have in place right now for individuals. Individuals pay taxes at a marginal tax rate that is based upon their taxable income. And so the greater your taxable income, the greater will be your marginal tax rate. And we'll talk about what the term marginal tax rate means a little bit later. A proportional tax, an example of a proportional tax might be a sales tax. Proportional tax just means it's like a flat tax. The tax rate does not change, and it isn't dependent upon the amount of money or income, or in the case of a sales tax, the amount spent. Tax rate is the same for everybody. And then finally, there's a regressive tax structure. This one is considered very disadvantageous for taxpayers, but we do have an example, and actually a few examples, but the primary examples in the tax code where we have actually a regressive tax system where higher earning taxpayers pay less, a lower rate, than do lower income taxpayers. An example of that is Social Security. So Social Security, everyone pays 6.2% every year, except when income reaches a certain level. In this case, in 2018 is over 128,000, and then those people who earn more than that stop paying Social Security or having Social Security withheld. And so that's regressive, because that means that higher income earners pay less into the Social Security system in terms of the percentage of income withheld than do higher income earners. So those are some examples of the three tax structures. And our focus in this course will be mostly on the the progressive tax system, which is based on marginal income. That is, the tax rate increases as the tax base increases. Another tax concept that is different than the marginal tax rate is the average tax rate. And the average tax rate is really considered your true tax rate. The average tax rate just takes your total tax obligation as calculated and divides it into your taxable income. So that is really the true tax rate that you're paying. You'll notice in the tax tables and in the tax schedule in Appendix C and F respectively at the end of your text that the tax that you pay on income is a function of your income, of your taxable income. And so, for example, as I said earlier, if your income goes up, then you'll be often elevated into a higher marginal tax rate. So what we mean by marginal tax rate is it means the tax on the next dollar of income, right? And so if you are taxed within a certain range at a certain percentage, let's say 22%, then if you earn enough where your taxable income puts you into the next marginal tax rate, that means that every dollar of income above that level will be taxed at the higher tax rate, the higher marginal tax rate. So if someone says to you, your marginal tax rate is 22%, it isn't that you're paying 22% on all of your taxable income. It's just that to the extent that your taxable income exceeds the lowest level in that highest marginal tax rate, only that amount will be taxed at that higher 22%. The average tax rate, as I said, is considered a little more accurate because it takes your entire tax obligation and divides it into, as I mentioned, your taxable income. And that gives you a better indicator of what your true overall tax burden is. So we'll be following a basic income tax formula in this course, and we'll be expanding on this throughout time, but this is really the basic formula for most taxpayers. Well, we have our income, our gross income, and we'll define that as we go along. And then we take out permanent deductions from income. We'll give some examples of that. For example, standard deduction. And that gives us our taxable income. We'll multiply that by the appropriate taxable rates, or we use the tax tables, to determine our tax liability. And then we're going to compare the tax liability, which is what we owed to the federal government, against what we've already paid. And if we have paid more than our tax liability, then we're entitled to a refund. If we have paid less throughout the year, for example, in employer withholding, then we will have a tax liability and we'll have to write a check when we file our tax return. One of the interesting concepts and ideas that come up is that most people are, and I was the same way, hopeful to get a tax refund. It's considered a good thing. However, a tax refund actually is not a good thing because it means that we have overpaid to the federal government, and the federal government, in other words, has had use of our money all year long, and when they return it to us, this over taxation, the extra money that they've held that's ours all year long, they'll return it to us in a refund, but they won't pay us any interest on it. So had we not had a refund, we would have had that money and we could have earned interest on it, or had it been available to us throughout the year. And so generally tax refunds are just from a financial planning point of view and a financial management point of view, tax refunds generally are disadvantageous, and they're something we'd like to avoid. On the other hand, if we underpay our taxes and we owe, say, less than $1,000, maybe $900 to the IRS, then we've received essentially an interest-free loan. And we are required to write a check, but we've had use of the IRS's money all year long, and we don't have to pay interest on that. Now, if the amount exceeds $1,000, generally, then we may have to pay interest on it and may be subject to some penalties. So taxpayers, as you know, we file annually a Form 1040, and we have a lot of new tax changes this year and for tax year 2018. And we have the Tax Cut and Jobs Act of 2017, late in December, that was passed and took effect in 2018. So this is the first tax cycle where we're going to be, those changes will affect our filing of our income taxes. And so we've just used 1040 with some additional schedules that we may or may not use, depends upon the complexity of our income tax return. So the components of 1040: wages, salaries, tips, commissions, bonuses, severance pay, sick pay, meals, lodging. These are all kinds of compensation that we've received that contribute to gross income, which we have to report then on our Form 1040, page 2 of Form 1040. And as you know, we receive a W-2 from employers indicating that we have had so much in earnings and so much withheld for federal income tax purposes. Any interest we've received from the banks, for example, we would receive a 1099 INT, which is a tax form that is also filed with the IRS that lets them know how much interest we've received, and we have to pay income taxes on that. In the next video, we will be completing this chapter and going through the assignment template.